Most of your tax planning has to occur during the year. This is 2013. You can do it in 2013 and essentially throw it back to your 2012 return. Probably the most important thing is to make contributions to an individual retirement account. A contribution to an individual retirement account is deductible. You do not have to itemize your deductions. It's deducted right off the top. And it's you can take a deduction for up to $5,000 or a little more, and you can do that all the way up to when you file your return on April 15th. It's just like picking somebody if you wanted to get heart surgery. You want to pick somebody who, that's what they do for a living. That's what they do 24/7, 365 days a year. And they work on your type, people's returns like your return, similar. They're not doing a lot of corporate returns necessarily, but they're doing individual returns.
You've got to use a little bit of common sense. You know, the CPA or the other tax preparer is going to prepare the return, but you're going to sign it. When you sign that, you are telling the federal government that I believe this information is true.
The IRS is really strict on filing on time. So some people think, well, I think I don't owe tax, so I just won't file this year. Or I'll file late after the 15th of the month, the 4th month of the year, which is typically when your taxes are due. So what will happen is there's a penalty for failure to file your return on time, and then there's also a penalty and interest that accrues each day for failure to pay what you owe the IRS. So what has happened many times, you'll have an individual thinking, I'm not sure if I owe anything, but I may not file. You should just go ahead and file and calculate what you owe. And if you can't afford how much you owe the IRS, still file on time and then ask for an extension or an installment plan to make the payment.